Iran destroyed Israel in just 5 hours. Iran took its revenge on Israel. In just 5 to 6 hours, Israel thought the night attack was over. 30 locations destroyed. Iran's oil reserves on fire. But then, by morning, something was flying through the sky, faster than anything Israel had ever seen. A missile. Not just any missile. A hypersonic missile. Heading straight for Haifa. And when it hit, the whole world went silent. But why did this happen so fast? And what does this mean for the rest of the world? The answer will shock you. Welcome to Currency Archives, the channel where we decode the stories that the world is watching. Now, friends, I have a small request. You know how your grandfather used to say, "Beta, good things should be shared." So, if you haven't subscribed yet, press that button right now. Just like you'd remind your grandfather to take his evening medicine, do it with love, do it now, and tell us in the comments, where are you watching from today? Are you in Pakistan, India, UK, USA, or somewhere else? Let us know below. We read every single comment. It was supposed to be a quiet night. But somewhere over the skies of Iran, the quiet was about to end. On that night, Israeli forces launched one of the most calculated and precise military operations the Middle East had seen in recent years. 30 locations across Iran were struck simultaneously. These were not random targets. These were not military bases. These were not government buildings. These were oil reserves. Iran's oil infrastructure, the backbone of its entire economy, was hit in a single night. The fires that followed were visible from miles away. Black smoke rose into the sky. Storage facilities that held millions of barrels of oil were reduced to burning ruins within hours. And the world watched in silence. Why oil? This is the question that every serious analyst, every economist, and every business leader asked when the news broke. The answer is simple and deeply strategic. Oil is not just fuel. For Iran, oil is everything. It is the primary source of government revenue. It funds the military. It supports the currency. It keeps the economy alive. When you destroy oil infrastructure, you're not just burning fuel. You are burning a country's financial lifeline. Israel understood this. The strike was not emotional. It was calculated. It was a message written in fire, telling Iran and the rest of the world that economic pressure can be applied at any moment from any direction with devastating precision. This is what modern conflict looks like. It is no longer just about soldiers and borders. It is about economies. It is about supply chains. It is about who controls the resources that keep nations running. Within hours of the attack, the world's financial markets began to move. Oil prices spiked. Investors panicked. Trading desks in London, New York, and Dubai lit up with activity. Analysts scrambled to assess the damage. Insurance companies began recalculating risk. Shipping companies started rerouting vessels away from the Persian Gulf. This is what happens when oil infrastructure burns. The fire may be in Iran, but the heat is felt everywhere. For young entrepreneurs and business owners watching from the sidelines, this moment carried a critical lesson. Geopolitical events are not distant problems. They are direct threats to supply chains, commodity prices, trade routes, and investment portfolios. Ignoring them is not an option. Understanding them is a survival skill. For several hours after the attack, Iran said nothing publicly. But behind closed doors, decisions were being made. Military advisors were being consulted, maps were being studied, targets were being selected. Iran's leadership understood that silence in this moment was not weakness. It was preparation. Then, in the early hours of the morning, Iran broke its silence. The announcement was brief. It was calm, but it carried enormous weight. Iran stated clearly that it would retaliate, not that it might retaliate, not that it was considering options. It stated, with full confidence, that a response was coming. The word retaliation sent a second wave of panic through global markets. Oil prices rose again. Safe haven assets like gold surged. The US dollar strengthened as investors moved toward stability. Stock markets in Asia opened lower. The economic damage from a single announcement, before a single missile was even launched, was already being felt across the globe. Here is what serious analysts noticed in those early hours. Israel had made a military decision, but Iran was about to make an economic one. The destruction of oil reserves was designed to weaken Iran financially, but Iran's response would be designed to send a different kind of message, one that said, no economy in this region is safe from consequences. The night attack on 30 oil locations was not the beginning of a war. It was the opening move in a high-stakes economic chess game. And the other side was now preparing its response. The board was set, the pieces were in motion, and the world had no idea just how fast Iran was about to move. 5 hours. That is all it took. While the world was still processing the images of burning oil fields in Iran, while analysts were still typing their reports, while markets were still reacting to the overnight strikes, Iran had already launched its answer, and it was not the answer anyone expected. a weapon that changed everything. Most people think of missiles as fast, but hypersonic missiles operate in an entirely different category of speed and precision. They do not simply fly toward a target, they maneuver, they adapt. They are designed to defeat even the most advanced defense systems in the world. Iran did not fire a conventional missile at Israel that morning. They fired a hypersonic missile. This single decision told the world something that no press conference, no diplomatic statement, and no political speech could have communicated more clearly. Iran was not responding out of emotion. Iran was responding with technology, with strategy, with a level of military sophistication that caught many Western analysts completely off guard. The target was Haifa. Why Haifa? Haifa is not just a city. It is Israel's most critical industrial port. It is the economic heartbeat of northern Israel. Oil refineries, chemical plants, shipping terminals, and energy infrastructure all converge in this single location. Haifa is where Israel's economic veins run closest to the surface. Iran knew exactly what it was doing. Just as Israel had targeted Iran's oil reserves to strike at its financial foundation, Iran chose Haifa to send the exact same message back. This was not a random act of aggression. This was a mirror strike, a carefully calculated response designed to say, if our economy burns, yours will too. When the hypersonic missile struck Haifa's oil reserves, the fires that followed were enormous. Black smoke rose over the city. Emergency services scrambled. Satellite images circulated within minutes on global news networks. Al Jazeera reported live from the ground as the scale of the damage became visible to the entire world. 5 hours. What this number really means. Here is what the business community must understand about that 5 to 6 hour window. In traditional military conflicts, retaliation takes days, sometimes weeks. Diplomatic backchannels are opened and international pressure is applied. Warnings are issued. There is time, however brief, for the situation to de-escalate. Iran gave the world no such window. 5 hours from attack to retaliation is not just a military achievement. It is a strategic statement. It tells every government, every military alliance, and every economic partner in the region that Iran has the capability and the willingness to respond faster than the world can react. For the business community, this speed carries a specific and serious warning. Supply chain disruptions, energy price shocks, and market volatility no longer come with warning signs. They arrive without notice. In 5 hours, the entire economic landscape of the Middle East shifted. Companies that were not prepared for this kind of sudden disruption felt it immediately. The economic damage, immediate and severe. Within minutes of the strike on Haifa, the numbers began to surface. Oil prices surged past levels not seen in months. Energy stocks in Europe and Asia swung violently. Shipping insurance rates in the eastern Mediterranean jumped overnight. Airlines began recalculating fuel costs. Refineries dependent on Middle Eastern crude started activating emergency supply protocols. And this was just the first wave. The deeper damage was not in the fires burning in Haifa. The deeper damage was in confidence, investor confidence, business confidence. The confidence that the Middle East, despite its tensions, would remain a manageable risk zone for global commerce. That confidence was now gone. The message behind the missile Iran's hypersonic strike on Haifa was not simply an act of military retaliation. It was a declaration that the rules of engagement in this region had permanently changed, that economic infrastructure is now a legitimate target, that speed, precision, and technology have replaced slow diplomatic responses. For entrepreneurs and business leaders watching this unfold, the message was impossible to ignore. The Middle East was no longer just a geopolitical risk on a spreadsheet. It had become a live economic emergency, and the shockwave was only just beginning to reach the rest of the world. The missiles had landed, the fires were burning, but the real destruction had not even started yet. Because what happened next did not take place in Haifa, or in Tehran, or on any battlefield. It happened in boardrooms, in trading floors, in shipping ports, in government treasury offices, thousands of miles away from the Middle East. The shockwave had arrived. When oil burns, the whole world feels it. There is a fundamental truth about the global economy that most people never fully appreciate until a crisis forces them to confront it. Everything runs on oil, not just cars, not just planes, everything. The plastic in your phone, the packaging around your food, the fertilizer that grows your crops, the electricity that powers your city, the ships that carry your products across oceans. Every single layer of modern economic life is connected, directly or indirectly, to oil. When Israel struck Iran's oil reserves, and when Iran struck back at Haifa, two of the most strategically important energy locations in the Middle East were simultaneously on fire. The global supply chain did not just shiver, it convulsed. The trading floors react. In London, traders arrived at their desks before sunrise to find markets already in chaos. Brent crude oil, the global benchmark, had jumped sharply overnight. Every percentage point of that increase translated directly into higher costs for airlines, shipping companies, manufacturers, and logistics firms worldwide. In New York, the opening bell on Wall Street rang into an atmosphere of controlled panic. Energy stocks swung violently in both directions. Defense stocks surged. Tourism and airline stocks collapsed. Investors who had been holding positions in Middle Eastern markets scrambled to exit before the situation worsened. In Dubai, the financial hub that sits closest to this conflict, trading volumes hit extraordinary levels. Wealthy investors moved money out of regional assets and into gold, U.S. Treasury bonds, and Swiss francs. The message from the markets was clear and unanimous. Nobody knew what was coming next, and that uncertainty is the most expensive thing in the world. The shipping crisis? Nobody is talking about. While headlines focused on missiles and fire, a quieter but equally dangerous crisis was unfolding at sea. The Persian Gulf and the Eastern Mediterranean are two of the most critical shipping corridors on the planet. Trillions of dollars worth of goods, oil, gas, consumer products, raw materials, pass through these waters every single year. When conflict erupts in this region, ships do not simply continue sailing as normal. Insurance companies immediately raise war risk premiums for vessels operating in affected zones. Shipping companies begin rerouting their fleets to avoid danger. Port operators in nearby countries go on high alert. Delivery timelines stretch. Costs increase. And the businesses at the end of these supply chains, the retailers, the manufacturers, the distributors, absorb every single dollar of that additional cost. For young entrepreneurs running import and export businesses, for small business owners dependent on reliable supply chains, this moment was a direct and personal financial threat. Not a distant news story, a real economic emergency landing at their door. Asia watches. And worries nowhere outside the Middle East felt this shockwave more immediately than Asia. China, India, Japan, and South Korea are among the world's largest importers of Middle Eastern oil. Their factories, their power grids, their entire industrial output depends on a steady and affordable supply of energy from this region. As news of the strikes spread across Asian markets, government officials began emergency consultations. Energy ministers held urgent meetings. Central banks prepared contingency strategies in case oil prices continued climbing. India, one of Iran's most important oil trading partners, faced a particularly difficult position. Rising oil prices would increase its import bill by billions of dollars. That pressure would filter directly into inflation, into food prices, into transportation costs, into the daily lives of hundreds of millions of ordinary people. This is the true scale of what burning oil reserves means. It is never just about the fire. It is about everything that fire sets in motion, across every ocean, every market, every economy on Earth. The warning that serious investors heard clearly. While panic drove most market participants to react emotionally, a smaller group of serious investors and analysts were doing something different. They were reading the situation strategically. They understood that in moments of geopolitical crisis, certain assets always move in predictable directions. Gold rises, defense stocks climb, energy prices surge, safe haven currencies strengthen. And for those positioned correctly before the crisis hit, these moments are not disasters. They are opportunities. But for those who were unprepared, for those who had ignored the warning signs building for months, for businesses that had no contingency plans for supply chain disruption, this was not an opportunity. This was a reckoning. The deeper question, as the smoke rose over Haifa and as markets continued their violent swings, serious analysts began asking a question that went far beyond oil prices and missile ranges. Were they witnessing a temporary escalation? Or were they witnessing the beginning of a permanent shift in how economic warfare is conducted in the 21st century? The answer to that question would determine the fate of businesses, investments, and economies for years to come. And the world was about to find out. The fires were still burning, the markets were still bleeding, and the world was holding its breath, waiting. Because everyone, from government officials in Washington to traders in Tokyo to small business owners in Karachi, understood one thing with absolute clarity. This was not over, not even close. The escalation, nobody wants, but everyone must prepare. For history has a pattern, and those who study it carefully know that when two nations begin striking each other's economic infrastructure, the conflict rarely stops at one exchange. It grows. The question that every serious analyst, every risk manager, and every strategic investor was now asking was not whether escalation would happen. The question was how far it would go, and how fast. Scenario 1, both sides absorb the damage and return to a tense but manageable standoff. Diplomatic channels reopen quietly. International pressure from major powers forces a pause. Oil markets stabilize at higher levels. The world exhales. Scenario 2, Israel responds to the Haifa strike with another round of attacks. Iran retaliates again. The cycle accelerates. Regional neighbors are drawn in. The Persian Gulf, through which nearly 20% of the world's oil supply flows, becomes an active conflict zone. Scenario 3, and this is the one that serious strategists fear most, the conflict expands beyond missiles and oil fields. Critical infrastructure across the region becomes a target. Undersea cables, power grids, financial systems. The kind of targets that do not just disrupt markets temporarily, but restructure the global economic order permanently. Smart money was not waiting to find out which scenario would unfold. Smart money was already moving. Which industries face the highest risk for the business community watching the situation develop? Certain sectors carried immediate and severe exposure. Energy companies operating in the Middle East faced the most direct threat. Their infrastructure, their supply lines, and their workforce were all operating in an active conflict zone. Risk premiums were rising by the hour. Aviation was next. Airlines dependent on Middle Eastern airspace for their routes faced immediate rerouting costs. Fuel costs were climbing. Passenger confidence in regional travel was collapsing. Logistics and shipping companies faced a dual threat. Rising fuel costs on one side, skyrocketing war risk insurance premiums on the other. Every additional dollar spent on moving goods through dangerous waters was a dollar taken directly from profit margins. Manufacturing companies in Asia and Europe that depended on Middle Eastern raw materials began stress testing their supply chains. How many weeks of inventory did they have? Could they source from alternative suppliers? At what additional cost? And technology companies, seemingly far removed from oil fields and missile strikes, faced their own quiet crisis. Data centers consume enormous amounts of energy. Semiconductor manufacturing requires stable energy supplies. Any sustained disruption to global energy markets would eventually reach the technology sector as well. No industry was truly insulated. No business was completely safe. What smart money is doing right now, while fear dominated the headlines, disciplined investors were executing strategies they had prepared long before this crisis erupted. They were increasing positions in gold and other precious metals. They were moving into defense sector stocks, which historically performed strongly during periods of geopolitical tension. They were buying energy stocks selectively, understanding that higher oil prices, while damaging to the broader economy, create significant profit opportunities for well-positioned energy producers. They were also doing something that most people overlook entirely during a crisis. They were building cash reserves, because experienced investors understand that crises create opportunities, but only for those who have the liquidity to act when the moment arrives. Panic selling by unprepared investors drives asset prices down to levels that rarely exist in stable times. And for those holding cash, those moments are not tragedies. They are entry points. The strategic advice for entrepreneurs and business owners, for young entrepreneurs and business owners, this moment carried lessons that no business school curriculum adequately prepares you for. The first lesson is that geographic diversification is no longer optional. Businesses that source entirely from one region, sell entirely to one market, or operate entirely within one economic zone are structurally vulnerable to exactly this kind of shock. Diversification is not just a growth strategy, it is a survival strategy. The second lesson is that commodity exposure must be understood and managed actively. Every business, regardless of its industry, has some relationship to energy prices. Understanding that relationship and having a plan for when energy prices spike is a fundamental responsibility of serious business leadership. The third lesson is the most important of all. The world is not becoming more stable, it is becoming more volatile. Supply chains that seemed reliable for decades are proving fragile. Geopolitical risks that once seemed distant are arriving without warning. The entrepreneurs and business leaders who will thrive in this environment are not those who react fastest after a crisis hits. They are those who prepared quietly, long before the missiles flew. The final warning. As Al Jazeera's cameras captured the burning oil reserves in Haifa, and as analysts around the world struggled to calculate the full extent of the economic damage, one truth stood above all the noise. The strike on Iran's oil infrastructure was not simply a military decision. Iran's hypersonic response was not simply an act of retaliation. What the world had witnessed in those 5 to 6 hours was something far more significant. It was a demonstration, a live, real-time demonstration that in the modern world, economic infrastructure is the new battlefield. That oil reserves, shipping corridors, financial systems, and supply chains are not protected by geography or international law. They are protected only by the strategic wisdom of those who build, manage, and defend them. For the business community, for young entrepreneurs, for serious investors, the message from those burning oil fields was not written in fire. It was written in the language of economics, and it said one thing with absolute clarity. The age of predictable, stable, comfortable global commerce is over. The question now is not whether your business is ready for this new reality. The question is whether you're willing to accept that reality before the next missile is already in the air,